Welcome and thanks for joining us tonight. My name is Andy Huang with Breakaday Capital. For those less familiar with us, we're a multifamily investment firm focused on acquiring and operating income-producing properties across the Southwest, primarily in Arizona. We work with investors looking to diversify into private real estate without taking on the burden of active ownership. Some of you may already know that we're in the final stages of fundraising for our BODC Multifamily Impact Fund, but tonight isn't about pitching a deal. This is a session focused on education, giving you a better understanding of passive investing, how to evaluate opportunities, and what it takes to be a confident limited partner. So with that, I'm excited to introduce tonight's speaker, Chad Ackerman. Chad is the founder of CARE, Chad Ackerman Real Estate, a coaching practice dedicated to educating and empowering new and inspiring limited partners in passive real estate investing. He's also a certified business coach with Focal Point, where he helps business owners build more sustainable operations. Before launching CARE, Chad spent over 25 years in the corporate world. He co-founded Left Field Investors, a nationally recognized community for passive investors that was later acquired by Bigger Pockets and rebranded as Passive Pockets. After the acquisition, Chad served as a strategic advisor to Bigger Pockets, before going all in on investor education and business growth through CARE. With that, I'll turn it over to Chad.
Great. Thanks, Andy. Appreciate it. Thank you for having me on tonight. Looking forward to sharing some information to some of your people on your list, which is great. So I'm going to share my screen and we'll jump into the slide deck, but get this out of the way. So, sorry, it's bouncing up again. So yeah, welcome this evening. My goal is to try to walk through some of the myths that people struggle with when they're looking at passive investing in real estate. Really just trying to round out some of your experience and help kind of maybe get some of you over a hump if you're struggling with some of this area that just, there is a lot of stuff in this space. It gets very tedious at times that I'm hoping I can debunk some of these myths for you. But my name is Chad Ackerman. I, again, want to thank Breakaday Capital for having me on tonight to talk through all of this. So let me make sure I can move through my slides. There we go. I'll start off. I always throw up a little disclaimer just to kind of note that, this is educational purposes. You do probably want to consult your tax advisors, financial planners, and attorneys if you have deeper questions about any of the material related to investing passively. But I always like to throw that up. You can read that at another point in time if you have a desire to do so. But quickly, welcome and introduction. Today, just what I want to walk through is a little bit of my background. Andy did a nice job with the bio, explained a lot of what I've been through, but I'll give you some of that detail. Then we'll jump into the myths and I'll try to bring some clarity and add some confidence to your background related to those myths and help you out with any of those. And then end with some actionable next steps is the goal, that we can turn you away from this webinar with something to do and some actions to take that might help you in your journey. So with that, I'll tell you a little bit more about myself. I am a father of two. My family's up there in the top left-hand corner. I have a daughter, Elizabeth, who's 21, going into her senior year at the University of Cincinnati, studying architecture. She's getting ready to go to Florence to study abroad here in a few weeks. So it's good to be Elizabeth these days, it seems. Then my son, Will, took the other path and he's gone into the trades and is becoming an electrician. And they're going to have a little competition. He's 19. They have a little competition who has more success in their life is what they say. So, and then my technically fiance for another week and a few days, Rochelle, we are set to get married a week from Friday, actually. So technically she's still my fiance, but I count her in all of this. But so I was a career W-2 guy, like Andy had said. I spent my time in comp and HR, about as far from real estate investing as you can get in the corporate world. And I always had a passion for real estate, never invested any of it. But I changed jobs in 2015 and I met an individual at the new job who kind of turned me on to the idea of finding another income stream beyond my W-2. And I liked the logic on it. I started studying it. There was a lot of shiny objects. I was trying to figure out how to get into the space. until I found a local meetup group through Bigger Pockets, actually, here in Columbus, Ohio, where I'm based out of. And the gentleman that ran that local meetup stood up and talked about at one meeting how he left his W 2 based on passive investing in real estate. And that was the switch that flipped for me and got me very excited. I met that guy, we became friends, and he got me trained on investing passively in real estate. And in the top right there, I'm standing next to the building, the first investment that I invested in, which is a Rockefeller building in Cleveland, Ohio. That was a 17-story building. So I watched all these shiny objects of single family things, all these HGTV kind of logic that I kicked around for a long time. But I ended up investing my first deal in this 17-story building in Cleveland. And we'll talk more about that throughout the night. But that made me an LP investor. And as I got into that, we started pulling together other like-minded individuals. And the 6 gentlemen that are in the middle there, that's our group that formed Left Field Investors. And Left Field Investors was meant to be a local meetup here in Columbus, and we were hoping to get 10 or 12 passive investors to attend it. Our first meeting was scheduled to be March 18th of 2020, and the world shut down 3 days before that for the pandemic. So we went on to Zoom like we're doing tonight, and that was we would not be here talking probably if we hadn't had the pandemic and went on Zoom. But that allowed us to grow our community. We started inviting people outside of Columbus. The 2 gentlemen on the left that helped found Left Field, one is in Montana and one's in Virginia. So it worked out well that we went on Zoom and grew from there, that we grew Left Field into a community of about 2,000 investors. And as Andy said, we eventually were bought out by Bigger Pockets. And now you can go on their platform and find Passive Pockets. And that is the community that we helped develop for the 4 years before we sold to them about a year ago. Our anniversary is coming up for that as well. But when I left that, I wasn't ready to be done. I was still very excited about the space, but I went out and got certified with Focal Point. It's a Brian Tracy organization, and got certified as a business coach. And then I blended that business coaching fundamentals and tools and resources with my experience doing Left Field and being an LP investor, that I formed CARE so that I could go back and help aspiring LPs find a way to move through this space and take action just like I did. My biggest thing was being able to take action and pull the trigger on something because I learned so much. So that's my goal, is to give back to the community and help people get over those humps that they're faced with. So that's a little bit about me, but that's been my journey along the way. So I want to start things off, and I don't know if we have enough people to get enough of a response here, but we'll try it. I want to ask if people can scan that QR code with their phone. Wanted to ask, what's the biggest truth that you're struggling with right now? So what's a hurdle that you're faced with in this industry that might help kind of where the conversation goes with the evening? Again, I don't know that we have very many people on, so we'll just kind of see if we get a feedback, or if not, we'll skip through this real quick. But any bumps in the road that people are struggling with that might be handy to have as we talk about this topic tonight? Well, we'll skip
I'll
through.
just interact with one myself.
Yeah, that's fine. Yeah.
In terms of timing, you hear stories all the time about whether it's a good time to invest in real estate, whether it's residential or multifamily. Maybe just talk about that.
Yeah, that's a great topic, because it's the are you willing to try to catch the falling knife logic, right? I am a firm believer deals can be found in any economy. You may just have to do deeper due diligence to be comfortable with it. But I believe there are deals to be found. There are operators, good operators like Break a Day, that are out there finding good deals in markets that seem like they're struggle. They just might be more difficult to find in struggling markets, if you will. But I'm a believer that you can find something at any point in time. Now, should you sit on the sideline some? Should you hold cash? It's up to your own risk profile, honestly, is the way I view it. And based on your risk profile, it's a very individualized thing. You may decide that, yeah, now's not the time. And in those cases, in my mind, going out and educating yourself more, talk to more operators, talk to more people that are in the space to gain more education while you're not investing. And maybe you're still watching deals and doing your due diligence, but go get some more education if you're not in the game at the time. And that's fine to do. But take your time. Make sure you're making wise decisions as you go through. So fair point, Andy. It's a good question. I'm going to jump on through and we'll get into this. So what's really holding people back? Most of the time it's misconceptions that I've seen. It's people just struggling. They're stuck in the analysis paralysis, trying to find their way through. And it's that education that I want to help bring to kind of alleviate those misconceptions, help people take those. Now, I'm no better than anybody else. I believed a lot of these myths myself when I got started, until I was able to get into a community and talk to people that were in the space and I could gain more knowledge about this. So that's what I want to go through and do. And I'm hoping tonight I can debunk some of these for a few of these topics that come up frequently anyway. So with that, we'll jump into this. So I'm a big myth fan. So I've got my Bigfoot picture here because I'm a big fan of the Bigfoot. But myth number one is I don't need a strategy. I just need to invest in what feels right, right? That seems simple enough. And the idea here is why do people believe it? Well, confidence, when they start into this game, typically your confidence grows. And after a few deals, people tend to let instinct take over as opposed to following their criteria. And that's a common thing that happens to a lot of investors. The truth is, without a clear strategy, portfolios tend to drift and they get off course and you don't correct. And then you end up chasing too many things. And that's where you get into misalignment, and that's where you get into emotional decisions. And to me, the more strategy you have, you take more emotion out of this whole process. And emotion to me is where you make your mistakes and where you get off kilter and you think something's going to work, but you maybe don't have the due diligence to back it up. So that's the caution I have with this kind of logic of I don't need a strategy. I think the strategy is one of the most important things that you can get into. Real world example for you. That first deal I got into in Cleveland, I got wrapped up in the sexy investment of this big building promising big returns that I jumped into it without really understanding my strategy. And as I grew and knew what my strategy was, my strategy really was cash flow. I needed cash flow because I was trying to get out of my W-2. Well, this investment in Cleveland was a 17-story office building that was going to be gutted and then turned into apartments and condos that wasn't going to cash flow for years. And so it really was a mistake to get in from my side for what my goals really were. So when I work with people, I start with goals, and we spend a lot of time on goals because you really need to have a firm understanding of what you want out of this space before you jump in. So the takeaway here is gut feeling isn't a plan, or hope isn't a plan. Define your goals, your risk, your comfort level, your criteria. Get all of that down before you start this process. And then it gives you a guardrails and a playbook to go off of do these deals that you're looking at fit into your criteria or not. You need to then be disciplined enough to stick to them. That's a whole nother thing. But the myth of not having a strategy, I think is a very poor myth to believe in because that strategy to me is the most important part of the whole process. And my pro tip for this one is create an investor identity sheet. Go through and map out all those criteria that are important to you and your goals for this, and then revisit it when you're starting to study deals so that you can tell whether the deals align to your criteria or not. By writing it down, it makes it a little more real. So I always encourage people to write it down. I've got a worksheet on my website that you can use if you want a template even, but that's myth number one. Do I need a strategy? I'd say yes, you do personally. So myth number two, the unicorn here. So myth number two is I've already invested with this sponsor, so I don't need to vet them again, right? So here again, why do people believe this? A good first experience builds trust, and that's very important. It also creates a sense of safety then that you got to be cognizant of and make sure you understand. But the truth is, every deal is different, even through the same operator. There are new risks, there are new teams, there's new structures. So you really need to understand and vet out, is this new team still viable for your criteria? Does it still make sense? Break a Day partners with different people, I'm sure, as they have different offerings. Understand who all is going to be involved, who are co-GPs, who's in the capital stack with you, and are you comfortable with all of that structure? Excuse me. Past success doesn't always guarantee that the next one's going to operate the same way. So take your time and study each deal independently of one another just to give yourself, the most knowledge you can on it, and don't be swayed by what's happened in the past. Real world example again. There are plenty of examples of operators that have done well until they didn't. And this mostly has been light has been shed on it over the past few years with the market shifts that have happened. So understanding that a revet of the operator and the deals that are coming through is important really got magnified as interest rates started to climb, insurance rates started to climb, and then all of a sudden operators that had good deals all of a sudden weren't. So do I want to continue to get on those deals or not? That all depends on your risk profile and so forth. So we've dealt with that a lot here lately, it seems like. But the takeaway here, trust the relationship by all means. This is a know, like, and trust business. If like you're engaged with a GP and you have a lot of faith in them, that's great. But always verify the details. Always make sure you go back and treat each deal as a fresh due diligence, so that you're always studying it with a clean slate and not being tainted by past history. Uh, and again, pro tip on this one, reassess every sponsor and every deal as if it's the first you've done with that operator. That way that you have this fresh look on the process when you go into it, knowing you've got some background on them, and that's helpful. So you've got some track record you can lean on, but make sure you understand who's new in the deal, who else is involved with it, so that you're comfortable with everybody that's engaged in this deal that you're about to invest in. But again, don't let familiarity be a shortcut for you. So myth number 3, if returns look good, it's probably a good deal, right? Well, again, why do people believe this? Well, a high projected return looks impressive and implies strong performance. By all means, if somebody's willing to write it on paper and say this is what they're going to do, sounds convincing. But the truth is, numbers can be manipulated. Projections are marketing, they're not reality. We often caution at left field and pass the pockets, beware of the good marketer that maybe isn't a good GP. There's some of them out there, and a lot of them have been exposed through this market shift that's happened the last few years. But you want to be cognizant of that and pay attention to it. The real world example, back to my Cleveland building, I fell in love with it as a shiny object because they were promising 7x returns, which sounded amazing. I thought, I'm going to hit a home run. This is going to be fantastic. Well, the reality of it is the individual couldn't get his construction loan, and this deal's going under. That rather than 7x returns, I'm probably not even going to see my invested capital return to me. So this ends up being a total bust for me, that I wish I would have been studying my criteria, know what I wanted to invest in. I would have passed on this one, and then I wouldn't be out that capital at this point in time. But lesson learned, you learn from these. Hopefully you don't have too many of those experiences, but they do teach you a lot as you lose that capital. But the takeaway here is look beyond the IRR. A lot of people love the IRR matrix, and I get it, but understand there are other things that need to be baked into your decision making, just to help you really analyze the deal. Don't get stuck on one number. And the pro tip here is start with a business plan and the assumptions. Understand what the story is as much as what the math is, to make sure it all makes sense. Just do that full due diligence when you go through a deal to make sure that it is a good deal. So myth number 4, I don't need to read the PPM if I trust the operator. Well, that is a big thing that I think a lot of people do, and I definitely feel subject to this as well. But trusting a sponsor feels good, and it's important. You definitely need to trust the sponsor, And those legal documents are miserable to look through. They are a lot of legalese. There's a ton of documents. Now, what I will say is the PPM is written, just to make sure everybody understands that that's an LP. The PPM is written from the operator to protect the operator. It's not technically there to protect the LP. So if something goes wrong, that's the document that everybody's going to go back to. So you should understand what's in it before you sign a deal to make sure you're comfortable with what the document says. And I, real world experience here, prior to 2021, I skimmed a lot of the PPMs that I had. I knew they had a lot of similarities, and I think that kind of made me want to skim through them a little quicker. But I didn't study things like what was the mortgage structure inside of the deal. And then when interest rates went through the roof and everybody had balloon payments due and they couldn't refi to pay the balloon payments, that hurt a majority of the operators that I knew that got hurt in this space. I didn't study that in the PPM when I was prior to 21. Now I pay attention to a lot of those things just to be sure that they're accounted for all the time, that people have learned their lesson from the last few years and are, have adjusted their underwriting to make sure that they're on par with risk that we didn't think would ever come around until they did a couple years ago. But the takeaway here, trust is good. By all means, trust is important with all of this, but informed trust is even better. And knowing what you're signing is very important. The beauty of the PPMs is generally they have similar flow or similar content in them, but it is worth a run through on them, each one that you're going to potentially sign on before you sign, just to understand what's in it. And my pro tip here, focus on key sections that are important to you. And this is individualized. You need to pick your own. Maybe it's fees, maybe it's the risks, maybe it's exit terms and voting rights. Whatever it is, make sure you are looking at the elements that you view as important for you to be comfortable with that investment. And even a 10-minute skim is better than nothing at all. So at least take the time to run through a quick review of the PPM before you do anything. Myth number 5, distributions are guaranteed. So why do people believe this? To me, I grew up in HR. I was in compensation. I feel the same thing happens to people in a W-2 with an annual bonus. If the annual bonus is paid enough years in a row, it kind of becomes regular distribution, kind of becomes a regular part of your income, and you feel like it's steady income. But in compensation standpoint, a bonus is discretionary. It could be there one year, it could be gone the next. Same thing can happen with distributions in the investments that you get into. So they are discretionary as well, and they're based on performance, not entitlement. So just because the PPM says that you have a preferred return, you only get that preferred return if the performance is high enough to pay the preferred return. So don't count on that cash flow being guaranteed. Really, it's hard to find anything guaranteed in this business. So like any investment, there are risks involved, and distributions are one of them. Now, real world examples, distributions happen pretty frequently in the latter half of the last decade because the market was so positive. It was on an upswing constantly that even bad deals got bailed out by good market, and distributions came pretty consistently. After the interest rates changed and everything pivoted, that's when we started to see distribution stopping. And let me preface, stopping distributions isn't always a bad thing. That could be that an operator is doing their job to save the overall investment by stopping distributions. So I don't want people to walk away from this thinking pausing distributions is a bad thing. There are definitely cases where pausing distributions makes sense and should be done. And that's a valid operator who's making that decision to try to protect your investment the rest of the way. There are other reasons that aren't always positive for distributions being paused, but I don't want everything to get lumped into one basket here. There are many cases of good pause distribution logic. But the takeaway here, the idea is count on potential, not promises. So protect your personal cash flow. Have margin of risk, have shifts in that, diversify, whatever the case may be, so that you can account for potential distributions that may pause and not upset the cash flow that you were expecting, kind of thing. Pro tip for this one, ask your operators, what happens if distributions are delayed? How long are reserves set up to be able to cover this kind of thing? All those are great conversations to have with the operator. Do it prior to writing, agreeing to the investment. And that is actually some solid questions to ask an operator to help vet them to see how they respond and decide if that meets your criteria or not in the way they respond and how they respond before you move forward. So it's a great conversation to have with an operator before you sign, is just get a firm understanding of that. I think there are a lot of LPs that are a little gun shy about distributions over the last couple of years, that I think this is a much more common question than it used to be. But distributions are not always guaranteed. Miss six. So the next one here, I can rely on others in my investment group to do the due diligence for me. So here, why do people believe it? Well, there's shared trust in community, creates a comfort level. So it becomes a shortcut. It becomes a crutch almost. You almost get sucked into that group think mentality, which can be dangerous. So be cognizant of that shared trust and what the chatter is in a community that you might be participating in, just to be sure you're following your own process. So the truth here is group insights are helpful. By all means, I encourage the community aspect. I'm a big fan of it, obviously, because I've started left field, work with passive pockets still, but understand that they're not suitable for your without your own research. You need to do your own due diligence as well, because ultimately your risk profile is your own, and you don't know that the chatter that's going on relates to your risk profile or goes against it. So you have to be careful of that. Real world experience here. So keep in mind, again, goals and strategies are very individualized and personal. So you can't rely on what somebody else thinks, because they may have different influences that are driving their decisions over what you have. So collect the data. The data is good. Leverage the community, but do your own decision making. To me, the group discussion is a data point, and you need to blend it with your own personal data points that align to your personal strategy so that you can make a solid decision. The pro tip here, use the group feedback again as input, as a data point, not a green light. Don't just go with the herd mentality. Run each deal through your own personal filter. That investment worksheet, have that criteria set so that you know what's important to you, and you can get the feedback from the group, but you don't follow it all the way through without running it through your own filters. And then myth 7, my last one here, diversification just means different operators, right? Well, spreading investments across different sponsors does feel like you're protected, and it does. By all means, we encourage, don't put all your eggs in one basket. But the logic here is, the truth is, there's more than one basket. It's not just sponsors. True diversification includes asset classes, the market, business plans, risk exposure. So there are a lot of different baskets that you need to consider when you're putting your eggs out there, not just who's running the deal by any means. So my real world example, I was heavily invested with one single operator when I started out, and I wasn't paying attention to the asset class as closely as I should, and see this dip in multifamily coming. I don't think a lot of us saw the dip in multifamily coming like it did, but that put me in a situation, because I had a majority of my passive income in multifamily. That put me in a bad spot, that I needed to diversify asset class just as much as operator. And then geography is the other big one, the market. The idea there being, don't put all your money into investments in Florida and then a hurricane comes and takes out your entire portfolio. And you're trying to pick up and go from there. So those are the big 3 that we usually talk about: asset class, geography, and the operators are worth taking a look at spreading those things around. And then the takeaway here is diversify with intention. So be meaningful about this. Broaden it across your strategies and your geographies so that you minimize that risk as much as you can. You only have so much money to put into this, so you don't want to waste any more of it than necessary. So be cognizant of what you're putting out there. And the pro tip here, track your allocations. Where are you putting your money? And literally write it down, track it in an Excel sheet or whatever the case is. put it on paper so that you can see where your gaps are and where your overlaps are, and whatever percentage you're comfortable with. I'm not saying only do one investment in multifamily. If you like multifamily, that's fine, but you probably shouldn't put all of it in multifamily. Come up with what percentage of your money you're willing to put in multifamily and go from there. But know how much you have in it so that you can pause getting in future multifamily until you rotate out of some, to maintain that criteria that you set. So again, this goes back to your goals and really spending time in your goals and writing them down to take that emotion out and have guardrails to drive off of as you go through this. But I'm going to pause there a little bit. Those were 7 kind of myths around that intermediate operator, intermediate LP as they invest that might cause them some drawback to invest in another deal. I wanted to note I've got another presentation that does more of myths around getting into investing. And I just want to call out a few of those to give you some more tidbits, depending on who's looking at this. And if you're more on the newbie side of things, one of the big ones that I hear often is that you need to be wealthy to invest in real estate. And by all means, capital helps with this, but there are many different ways to get into this space. One of the big ones I know is a company called TriVest that allows you to group invest with other people, friends, family, colleagues, whatever, that maybe if you have a deal you're trying to get into that's $100,000 minimum, that's too steep for you. Well, you could start a tribe where maybe you get 10 people and everybody puts 10 grand in, and then you can get into that deal. But you spread your risk out by getting in at a lesser amount. But the other tidbit, the other footnote I'll say to everybody, always ask an operator, especially the first time you invest with them, ask them if you can get in for less than the minimum. And majority of the time they'll say, yeah, we'll let you in for less than that, just to meet you and have you kick the tires and come along with us and try to figure out if we're good partners. So always ask about that. It's a good tidbit to focus on. Another one is you can't invest in if you're not accredited. I am not accredited still. I'm a non-accredited, sophisticated investor at this point. And I helped run a community for several years. I've been investing since 2018. There are deals out there to be had for non-accredited folks. There's fewer of them. It's harder to find them, but there are deals to invest in that are non-accredited. So don't let that pause you necessarily either. Another one is my financial advisor says this stuff's coming out of left field. My little paying homage to the old company. This was exactly why we named Left Field Investors what we did. Understand your financial advisors, in many cases, they're not going to get commissioned on you investing passively in real estate. So some of them, hopefully you have a good investor and they'll encourage you to look at this space. But there are definitely some out there that would discourage you because they don't get paid on it. So be cautious of that. And then passive investing means no work at all, right? Well, we coined the phrase saying you need to be an active passive investor, really is what you need to be. You need to do that due diligence. You need to spend time in your goals and your strategies, and then use that criteria to vet operators and vet deals. You get passive in a deal once you write the check and sign the document and send it over. But even after that, you need to watch the communications that come in on a deal and make sure it's tracking the way that you thought the deal was going to flow based on what the operator said to you. Keep tabs on distributions. Are they coming in as they said? So there is work to do. This isn't sit back and let it ride. There is work to do, especially up front, because like the operators, you make your money mostly on what you do up front. The LP, it's just vetting the deal and vetting the operator is what they're involved in. And then all real estate investments are the same. Obviously, that's not the case. This space has multifamily, self-storage, commercial triple net lease, retail, office. Then you get into the alternatives, as we call it, in car washes and laundromats and marinas. So there's a versatile dichotomy of asset classes to pick from that you can, by all means, look through all of them and decide which ones work for your strategies. Each one has a slightly different strategy to it. So if you're a cash flow person, you probably don't want to go invest in construction, ground up construction, because they're not going to cash flow for a long period of time. If you're looking for equity, triple net lease deals may not be your way to go because generally they don't turn over a lot of equity because there's no value add there for the operator usually. So understanding the asset classes becomes really important as well. So I'll pause there. I've hit you with a ton of different myths and some logic behind them and everything else. But I just wanted to expose a lot of these different things that people think about, that I hear about, and talk about why they maybe are true or maybe aren't totally true to help you with maybe your confidence as you go through this. But at the end of the day, the real barrier that I've seen isn't these myths at all. It's really just taking action. That people, again, get stuck in that analysis mode and they just struggle with the analysis, which I get. You should do your due diligence by all means, but they have that fear of making a mistake and, keeps a lot of people on the sidelines. This is why I like to encourage people to get into communities, because you can do your own due diligence, but you can vet that with other like-minded individuals that may be looking at the same deals you are too, and test your logic and understand so that you get more confidence because you have more feedback then, that it's not just you that views that deal in a certain way. It would be other people, but you're never maybe going to feel fully ready, and that's okay. It's more about taking that first step, and that's usually the hardest one, but once you take it, you learn a lot from taking that step. So I encourage everybody to think about that and go through it. And then the last thing here is you don't have to go it alone. There's guidance and community that can really drive your process and make a difference. I'm happy to help coach and have conversations. We can have a one-on-one conversation, talk about where you're stuck. But even getting involved in a community and having that group of people that are like-minded to be able to encourage you through is very valuable, I think. But the goal is to try to give you enough confidence to take the step anyway. A last pro tip here. So start by identifying what's holding you back, and then take one small step intentionally to go against that thing that's holding you back. And if you're unsure what that step looks like, then, feel free to reach out to me or find somebody else that's in a community that you trust that can walk you through that and talk about what you're struggling with and help you figure it out and help you get over that hump and see if you're ready to make that next step. So last thing, again, I don't know if we've got enough people on, but I was going to ask just what do you have that you learned from today's webinar that you might implement? I don't know, Andy, if there's any feedback that you've got in there from what all was shared. A lot of myths to bust there.
Yeah, I mean, thanks for the great content, Chad. I think that you've addressed several items today that a lot of investors go through, especially ones that are just starting out. So I think that's very helpful. I think we can open it up to questions and Q&A now. So if anyone has any
Yeah,
questions,
that'd be
so
great.
use the Q&A box. But I'll get the ball rolling, and I'll just ask,
Okay.
which of these myths do you see trip up even the most experienced investors?
Yeah, I think a lot of it has been studying that PPM and then getting caught in something that they weren't aware, some of the fine print that they get tripped up on in a situation. And biggest reason that's getting exposed is just because the market has changed so much that there are deals that are going wonky more so than they were 10 years ago. You could be any operator on, I won't say that. I don't want to shortchange Break a Day because you guys have been successful for a long time, but there were a lot of operators that were new to it and had a lot of success because the market did so well, and people got away from watching that PPM and digging into those numbers, and that caused a lot of experienced people to get by it. One of the most experienced LPs that I know is Jeremy Roll. Jeremy is the most diligent PPM reader that I've ever met in my life with every single one he does. And he'll go back and ask questions on every one he reads that I wish I had that discipline. I want to learn that from Jeremy someday, but I don't have it yet.
There, some
Good
of these
question.
documents can be over 100 pages long. What are your thoughts on perhaps using maybe AI to help a little bit these days? There seems to be a trend in people using that to sort of look for red flags.
It is. I think what I've studied on it and what I've seen from the community, AI can be a handy tool. It's kind of like the community feedback though. It's not good enough to tell you yes or no yet. It isn't good at comparing your criteria to what is in the PPM, but it may be good about calling out what's not in the PPM that you ought to ask about. So there are elements that AI could be very helpful for that. A lot of it, you got to feed it, you got to educate it to tell it what you want to see in a PPM, and then it can compare. So it's not there yet. It's not totally going to do the job for you. Treat it as a data point still, if you want to go that route, but don't treat it as your red light, green light kind of thing yet. It's not there yet.
Got it. And we do have a question from someone in the audience. So the
Great.
question is, do you assist investors in the acquisition of hard assets slash real estate, or is your company limited to syndication funds only?
So my company, Chad Ackerman Real Estate, I actually don't do any capital raising at all. I'm not helping. I'm not licensed to collect capital from anybody, so I'm not doing deals specifically. I'm here purely to educate LPs and help them along the way to go make their decisions to go vet deals that they want to get into. So slightly different approach. I'm purely here to help the LP along and get them going.
Got
But
it.
good question.
And there was another question out there, which is, you talked about earlier, there's a downward trend in multifamily a few years ago. So I guess the question would be, how did these myths show up differently in today's high interest rate environment versus a few years ago?
So it's a good question. I think one of the hottest questions out there in the industry right now is multifamily back or is it coming back? And this is where it's hard to answer broadly because your investment criteria drives whether you feel multifamily is back or not. There are a lot of people that have a high risk tolerance that think, yeah, now we're starting to see. I will say I'm seeing more multifamily deal flow showing up, so it seems like it's picking up. But it's your own kind of risk tolerance of, is it good time to get in, or are these deals still a little too risky for me that I'm not quite there yet. So it's hard to answer it with a broad stroke, but multifamily is definitely going to have its comeback. It will get back. It's too important to the national economy that it won't get there. Whether it's there now or not, that's, again, I view it as an individualized decision. I have not invested in another multifamily deal yet since 2021. I'm still looking for the right deal, but I'm also low on capital these days. So I'm happily on the sidelines because I don't have any money to invest. It's not a bad place to be right now.
Right. Well, great. I think that's all the questions we had. And thanks for your time. Chad, if
Yeah.
you want to put back the page with your contact information to give people
Yeah.
a chance to scan the QR code. So
Absolutely.
feel free to reach out to Chad directly if you guys have any questions. Break a Day Capital is always here to help out as well. You can email me directly at andy@breakofdaycapital.com or go directly to our website, breakofdaycapital.com. And here you see Chad's contact information. So yeah, reach out to either of us if you have any questions. We're always here, happy to help, and hope everyone has a good night.
Yeah.
Thanks
And
again.
thanks, Andy. Thanks, Break a Day, for letting me come on tonight. Really appreciate that. It was great to come out and share with the community a little bit. But yeah, if you have any questions, feel free to reach out to me as well. Happy to help.
Great. Have a good night, everyone. Bye.